Welcome back to Iron Financial. If you have been keeping a close watch on the industrial sector, or, more specifically, the gritty, essential world of aerospace and defense, you probably felt the ground shake a little bit today. AAR Corp, ticker symbol AIR, just dropped their fiscal year 2026 second quarter earnings report. And honestly, to put it mildly, they didn't just beat expectations, they absolutely crushed them in a way we rarely see from established industrial players. We are talking about a serious, undeniable double beat on both the top and bottom lines, profit margins that are expanding right when the economy needs them to, and perhaps the most exciting part for us as investors, a significant raise in their guidance for the rest of the year. Over the next 10 minutes or so, we aren't just going to read through the press release headlines, because let's be real, anyone can do that. We are going to dive deep into the actual numbers they released today, Tuesday, January 6th. We're going to look at exactly what management had to say on the conference call that just wrapped up, and we are going to uncover the specific growth engines driving this stock that some of the mainstream financial outlets might overlook. But first, we have to get the standard disclaimer out of the way. I am an AI voice for Iron Financial, not a financial advisor. This video is made for educational and entertainment purposes only. The stock market always involves risk, so please, always do your own due diligence before making any investment decisions. Now, let's pop the hood on this incredible quarter for AAR Corp and see what is really firing inside the engine. Coming into this report, Wall Street was actually feeling pretty cautious. The consensus estimate among the big analysts for earnings per share was sitting right around $1.02. They weren't expecting a blowout, they were expecting steady, maybe even slightly boring, performance. Well, AAR blew right past that cautious optimism. They reported an adjusted EPS of $1.18. Now, do the math with me, that is a 16-cent beat per share. In the world of typically low-margin industrial businesses, delivering a 16-cent beat isn't just a good quarter, it is a massive outlier. It fundamentally changes the thesis on the stock. And on the revenue side? The story is just as strong, if not stronger. Analysts were looking for the company to bring in about $761 million. AAR actually brought in $795 million. That's a beat of nearly $35 million. Year over year, their sales are up 16%. Now, 16% top-line growth for a mature, established industrial company is already incredibly impressive on its own. Usually, you see that kind of growth in tech, not in aviation maintenance. But the real magic in this report, and the thing that likely has the big institutional investors excited right now, is what happened further down the income statement. It's not just about how much revenue they made, it's about how much of it they actually kept as profit. This is where we start getting into the weeds of why this company is performing so well right now. It's really a story of a financial concept called operational leverage. Remember, I just mentioned that sales grew by 16%. That is a great headline number. But their adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, actually grew by 23%, hitting $97 million for the quarter. Think about that for a second. When your profit grows significantly faster than your sales, it means you are becoming much more efficient as a business. You aren't just selling more stuff, you are keeping more pennies out of every single dollar you bring in. Their adjusted EBITDA margin expanded to 12.1%, which is a nice jump up from 11.4% a year ago. On the conference call, CEO John Holmes specifically highlighted this point, and he sounded very confident about it. He noted that the company successfully translated the top-line growth into even stronger bottom-line results. This is crucial because it shows management has tight control over their costs, even while they are scaling up rapidly to meet demand. In an inflationary environment like this, where labor and materials cost more every day, seeing margin expansion is the mark of a very, very healthy industrial operation. It means they have pricing power. So, you might be asking, Where is all this growth actually coming from? AAR Corp isn't just one single business, it's really a complex collection of critical services that keep aircraft flying. Let's break down the segments, based on the data they just released and the color commentary from the call. This is where we find the really interesting narratives that aren't always in the bold headlines. This segment was the absolute star of the show this quarter. Sales here were up a staggering 29%. Why is that happening? Well, think about the macro environment we are in right now. Airlines are absolutely desperate for capacity. New planes from Boeing and Airbus are facing constant manufacturing delays. The global supply chain for new parts is still snarled up. So, what do airlines do? They have no choice but to keep flying their older planes longer. And when you fly older planes, things break. You need replacement parts. AAR is a master of used serviceable material, or USM. They tear down old planes and sell the certified parts. This business is booming because the world's airline fleet is aging, and AAR is perfectly positioned to supply that exact need. This is an area I really want to highlight because it represents a significant strategic win for the company. Management noted on the call that this segment saw organic sales growth of 32%. Organic is the keyword you need to focus on here. It means they didn't just go out and buy another company to pad their stats. They are winning new contracts and taking market share away from competitors the hard way. A 32% organic growth rate in the distribution business is incredibly strong and shows their sales team is executing flawlessly in the field. Government and defense sales increased by 23%. This shouldn't be too surprising given the global geopolitical climate we see on the news every day. Defense spending is trending up globally, and governments need their existing fleets of transport aircraft and helicopters ready to go at a moment's notice. AAR provides the logistics and parts to keep those military assets operational. This provides a nice, steady tailwind alongside the booming commercial sector, balancing out the portfolio. Okay, so Q2 was great. We've established that. But the stock market is a forward-looking mechanism. It doesn't care about what you did yesterday, it cares about what you are going to do for me tomorrow. And this is where AAR Corp really dropped the mic on the conference call. Usually, companies beat earnings and then offer cautious, conservative guidance to play it safe. They want to lower the bar so they can jump over it again next time. Not AAR. They poured gasoline on the fire. For the upcoming third quarter, they are now forecasting total sales growth of 20 to 22%. Remember, they just grew 16% in Q2. They are telling us that business is actually accelerating going into the next few months. They expect things to get better, not worse. Furthermore, they raised their full-year guidance for organic sales growth. They were previously targeting approaching 10%. Now, they have bumped that up to approaching 11%. When a company raises its full-year outlook halfway through the year, it signals tremendous confidence in their order book and their visibility into future demand. They aren't guessing, they likely have the contracts already in hand and know exactly what is coming down the pipe. So, putting it all together as we wrap up this deep dive here at Iron Financial. AAR Corp right now is sitting in what professional investors call the sweet spot. They are benefiting from a perfect storm in the aerospace industry. The difficulty that airlines are having in getting new planes is actually AAR's gain. Every day that a 15-year-old Boeing 737 or Airbus A320 has to stay in service is another day that AAR gets to sell parts and services for it. They have demonstrated, through their 23% EBITDA growth, that they can manage this high demand efficiently and profitably. They aren't just growing for growth's sake, they are growing smart. And finally, their raised guidance tells us that this trend isn't slowing down, it's actually speeding up heading into the back half of their fiscal year 2026. Today's report wasn't just a simple earnings beat. It was a statement that AAR Corp is firing on all cylinders in an environment perfectly suited for their business model. Thanks for watching. If you found this deep dive helpful, please hit the like button, it really helps the channel grow, and subscribe to Iron Financial for more in-depth market analysis just like this. I'll see you in the next video.